We have been living in a Great Depression since the Dotcom bubble, the global depression. Before we dive into why I say we've been living in a depression since the 2000s, we need to get our terms straight. Words like recession, depression, and deflation get thrown around a lot, but they actually mean different things. Let's break it down.
1. Recession. Simple definition. A recession is when the economy shrinks for a while, usually measured as 2 quarters in a row where GDP goes down. GDP equals gross domestic product, basically the total value of everything a country produces. Think of it like the report card for the economy. It's basically the country's yearly income, like your paycheck but for the entire nation. So if GDP is going up, the country is earning more. If GDP goes down, the country is shrinking, and that's a bad sign. What it feels like. Layoffs go up, people lose jobs. A recession, one of the first things people notice is layoffs. That simply means people lose their jobs. Think back to the COVID lockdowns. In the U.S., unemployment jumped from 3.5% to nearly 15% in just 2 months, the highest since the 1930s. Over 20 million people lost their jobs in April 2020 alone. But the biggest shock wasn't just in the U.S. and America. Joblessness jumped from 3.5% to nearly 15% in 2 months, the sharpest rise in modern U.S. history. But in Colombia's capital, Bogotá, it went even higher, doubling from 13% to over 26%. That's a 13-point jump, one of the steepest anywhere in the world. That's how fast a recession can hit home. Businesses cut spending, and people hold back on buying big things like cars or houses. Duration usually lasts a few months to maybe a year or two. 2. Depression. Now let's move up a level. If a recession is like the flu, painful but short-lived, then a depression is like a chronic disease. It doesn't just go away in a year or two. It lingers, it weakens, and it changes how society works. What is a depression? Definition. A depression is a downturn that's deeper and longer than a recession. Measurement. Economists generally use 2 rules of thumb. GDP, yearly income, shrinks by more than 10%, or the downturn drags on for 2 years or more. What does it feel like? High unemployment for a long time, not just months, but years. Wages don't recover. Even when jobs come back, paychecks don't stretch as far. Businesses close permanently, not just temporarily. People shift into survival mode, saving every penny, cutting back on everything. Example, the Great Depression, 1930s. In the U.S., unemployment hit 25% by 1933. GDP fell by almost 30% between 1929 and 1933. It lasted a full decade, only ending with World War II. Silent depression. You don't always notice a depression right away. Sometimes governments print money and inflate asset prices, so it looks like growth on paper, but ordinary people feel poor year after year. Sound familiar? Generational impact. People who lived through the 1930s depression saved obsessively for life. They distrusted banks, avoided debt, and passed that mindset to their kids. A depression doesn't just hurt wallets, it reshapes culture. In Germany, during the early 1920s hyperinflation crisis, money became so worthless that workers were paid twice a day and rushed out to spend it before prices went up again. There are famous stories of people pushing wheelbarrows full of cash just to buy a loaf of bread. That experience scarred an entire generation, making Germans far more cautious about inflation and money management for decades afterward. So a depression isn't just a deeper recession. It's a long-lasting breakdown where jobs, wages, and living standards don't bounce back. Official numbers might eventually say the economy is growing again, but for ordinary people, it can still feel like the grind never ends. So a depression doesn't just hurt wallets in the moment. It reshapes how whole societies think about money, savings, and risk, sometimes for generations. 3. Deflation. Now let's talk about deflation. On the surface, it sounds great. Prices going down. Who wouldn't want cheaper food, cheaper cars, cheaper houses? But in economics, deflation is actually one of the scariest things that can happen. What is deflation? Simple definition. Deflation is when prices across the economy keep falling for months or years. Measurement. We track it using inflation numbers. If inflation is below zero, say -2% or -5%, that's deflation. Inflation equals prices rising. Deflation equals prices falling. Why is it a problem? If people think prices will be lower tomorrow, they stop buying today. Businesses make less money, so they cut wages or lay people off. With fewer people buying, prices fall even further. It creates a vicious downward spiral, like an economic black hole. And remember, debt doesn't shrink in deflation. If you owe $1,000, but your income keeps dropping, that debt feels heavier and heavier.
Historical example: Japan's last decades. In the 1990s and 2000s, Japan suffered long-term deflation. Wages stagnated, people stopped spending, and companies hoarded cash instead of investing. Lesser money circulating back into the economy. Their economy barely grew for more than 20 years, even though technology and productivity were advancing. Great Depression prices. In the US during the 1930s, consumer prices fell by nearly 25% in just 4 years. Imagine your paycheck shrinking every year, while your mortgage payment stays the same. Cash becomes king. In deflation, people who hold cash actually gain power, because their money buys more over time. But that also means the wealthy, who already hold most of the money, get even stronger, widening inequality.
So deflation might sound like a shopper's dream, but in reality, it crushes economies. People stop spending, debt gets heavier, and inequality grows. And when deflation combines with depression, that's when economies can get stuck for decades. But to escape this martingale cycle, since 1900 to 2025, governments basically have two levers when stuck in a depression-deflation trap. Option 1, to print more plus, spend more equals, inflate the economy back to life. Short-term relief, jobs created, nominal GDP looks better, but it often fuels asset bubbles, stocks, real estate, leads to wealth inequality. In the long term, debts grow even bigger. Option 2, war equals destroy the old system and rebuild on the ashes. Destroy old debts, reallocate resources, and restart the system. This is what happens in real life when the Monopoly board game ends. Or controlling the narrative, and new financial rules or new currency or money systems like CBDCs soon. Now we understand what recession, depression, and deflation is.
So now, why we've been living in a depression since the dot-com bubble, here's the shocking claim. Even though governments tell us the economy has been growing for the past 25 years, when you measure it honestly, not in paper money, but in gold, we've actually been stuck in a depression since the dot-com bubble burst in the year 2000.
The dot-com bubble and aftermath. In 2000, the tech bubble burst. Stocks crashed, growth slowed, recession hit. Instead of letting the system reset, governments chose escape door, option 1, print plus spend. The U.S. Federal Reserve cut interest rates to historic lows. Debt levels soared. Households, companies, and governments all borrowed more. What happened in gold terms? In fiat terms, GDP, wages, and stock markets looked like they were growing. In gold terms, all of that was shrinking. Example, the U.S. stock market S&P 500 in 2000 was worth about 5 ounces of gold. By 2011, it fell below 1 ounce. Translation, if you measured wealth in something real like gold, your portfolio lost around 80% of its value in that decade. Same with wages. Median incomes stagnated in fiat dollars, but in gold terms they collapsed.
I repeat, if you measured wealth in something real like gold, your portfolio lost around 80% of its value in that decade. Now, following on with 2008 crisis, Maori printing, housing bubble popped, banks collapsed. Governments doubled down on printing and bailouts. In fiat, the recovery looked strong. Stock markets soared. GDP rose. In gold, it was another story. The rise was mostly illusion. Real purchasing power continued to erode. Following on the 2020 COVID crash, the printing bazooka. Governments used helicopter money, checks to households, trillions to banks and corporations. Fiat GDP recovered fast. Stocks hit record highs. But in gold terms, again, it was a depression. Governments were just inflating the denominator. Why it's still a depression today? 2025. In gold, wages are down. In gold, stocks haven't kept up with their bubble highs. Global debt has exploded past $300 trillion. Wealth is concentrated in assets, stocks, real estate, government bonds, all inflated by central banks. Ordinary people, their wages haven't kept up with gold, energy, or housing costs. In gold, housing and energy are far more expensive relative to incomes. This is the exact definition of a depression in real terms. Long-lasting decline in living standards, masked by paper money growth. The 2 escape doors, revisited. Option 1, print plus spend. This is the door we've been using since 2000. Central banks keep interest rates low. Governments keep debt recycling. It buys time, but inequality grows and the system gets weaker. Option 2, war reset. If the printing door stops working, if trust in fiat collapses, history shows the other escape is conflict. Wars erase debts, destroy old wealth, and create the excuse for a new monetary system. So while official numbers say growth, the gold standard says depression. For 25 years, governments have kept us afloat with the print and spend escape door. But every time that door loses power, the war door gets a little closer. Fiat says, we're growing. Gold says, we're in a depression. But there's now a third player on the field, Bitcoin. And when you measure the world in Bitcoin terms, the illusion of growth collapses even further. The U.S. stock market. In 2011, 1 Bitcoin could buy about 1/10 of an ounce of gold. By 2021, 1 Bitcoin could buy over 30 ounces of gold. Housing in gold, 1,950. While the exact dollar figure isn't directly cited, the consensus based on mid-century housing to gold ratios indicates it took around 505 ounces of gold to buy a house. On year 2000, at a median home price of $119,600 and gold at $284 Oz. A house cost about 420 ounces of gold. 2025, with median homes around $416,900 and gold skyrocketing to $3,300 Oz. The required gold drops to about 126 ounces. In short, in Bitcoin terms, almost every asset in the world, stocks, houses, bonds, has been collapsing. Wages? In fiat, wages look flat or slowly rising. In Bitcoin, wages have been falling off a cliff for over a decade. Savings. A dollar in the bank lost most of its value to inflation. Gold held its ground somewhat. Bitcoin multiplied purchasing power many times over. Bitcoin acts like a truth serum for money. In fiat terms, governments can hide the depression by printing more. In gold terms, the depression is visible but slow-moving. In Bitcoin terms, it's undeniable. The old system is collapsing in real time. So yes, in fiat, the story looks okay. In gold, it's been a depression since 2000. But in Bitcoin terms, the system looks broken beyond repair. And that's why the rise of crypto isn't just about technology or speculation. It's about a third way out of the depression, a reset without printing or war. Here's the truth. If you measure the last 25 years, in fiat, governments will tell you growth is everywhere. GDP is easing, markets are up, technology is booming. But that's the facade. Use the S&P 500 to gold ratio, how many ounces of gold it takes to buy the S&P 500. Historical charts show a sharp decline from around 40 ounces in 2002 down to below 10 ounces. The S&P 500 dropped approximately 70 to 75% from 2002 to date. If during 2000 to 2011 it dropped approximately 89% decline in gold terms, that's almost exactly the same magnitude as the Dow Jones crash during 1929 to 1932 in the Great Depression, menos 89%. U.S. GDP per capita has risen from around $36,000 in 2002 over $80,000 by 2024. That's a dramatic drop of about 82 to 83%. In gold terms, a hallmark of a long-term depression in real gold purchasing power. If you divide food prices by gold, the story flips. $2,100 worth of groceries approximately equals 0.37 ounces gold. 2025. $200 worth of groceries approximately equals 0.057 ounces gold. That's an approximately 85% drop in cost measured in gold. Fuck me, Holy Mother Mary. But remember, after Nixon shock, gold is removed. But gold was the main measuring stick for the last 5,000 years. After Nixon shock, dollar became the measuring stick. Remember housing dropped 80%. You probably didn't understood it just now when I mentioned it. Scream with Mother Mary now. Medium wages dropped 87% according to your Forbes 2013. And yes, it is still stagnated. At this point, there isn't a need to even mention to measure price in Bitcoin. Not just the US. It's a global invasion. Gold is universal. It prices the same everywhere. Whether you live in the US, Europe, China, or Africa, if you convert wages, GDP, or housing into gold terms, the decline looks the same. I call it the Wi-Fi wasteland greater than the Great Depression, 1929 depression. The economists haven't even named it yet, because we are still in it. So, in gold terms, we've been sinking since the Dotcom crash. Wages, savings, and purchasing power all in long decline. That's the definition of a depression. In Bitcoin terms, the illusion collapses completely. Against absolute scarcity, the entire fiat system looks bankrupt. And here's why young people feel it the most. Millennials, Gen Z, they're priced out of housing, buried in student debt, and earning wages that don't keep up with real costs. They live in what feels like a silent depression because they're told the economy's fine while the reality says otherwise. Why isn't the collapse so obvious? Because unlike the 1930s in Germany, where people literally pushed wheelbarrows of cash for bread, today we have the internet. But here's the difference. Today is not 1930s Germany. Back then, people were trapped. Wealth was local. Opportunities limited. Mobility non-existent. Now, we have the internet. Avengers is still airing. Wealth is mobile. Technology gives you access to markets, tools, and communities no generation before you ever had. You can build, you can move, you can adapt in ways unthinkable during the last Great Depression. Yes, we are living in a depression, but this time you are not powerless. So remember, this isn't just the longest depression of modern history. It's also the first one where you're not trapped by geographer or by rulers. The world is still in crisis. But for the first time, you have the tools to step outside the system.